Okay, so this is financial focus portion of our webinar. If you're just joining us, please be sure to hit the subscribe, like, and notification buttons. And today we're talking about 2025 year-end planning. So let's jump into it. I am going to share my screen here. So we are talking about 2025 year-end planning. So I'm first going to talk about deadlines. So we have important deadlines that we have to consider. The first, and I kind of listed these in chronological order, so you know what to pay attention to first. So our deadlines are first October 15th of 2025. So this is obviously coming up pretty quickly. Here we are today, September 24th, 2025. So you have a little bit of time, and that's correcting 2024 IRA contributions. So you have the opportunity for up until October 15th of 2025 to remove or recharacterize any excess contributions or unwanted contributions into your traditional IRAs or Roth IRAs, plus any attributable gain and loss associated with that. But that must be done by October 15th of 2025. You also have another deadline, October 15th of 2025, but only if on extension, if you want to make 2024 SEP IRA contributions. So a SEP IRA is typically for small business owners, and many times they're for, maybe one or two employees, and they're typically family or very, very close individuals. But SEP IRA contributions, if you have an extension and for your 2024 tax return, then you may be able to make contributions still into your SEP IRA. So that's not the same with traditional IRAs, whether or your own personal IRAs, whether they be traditional or Roth IRAs. Those contributions have to be made by the typical tax filing deadline, which is usually April 15th, unless that date falls on a Saturday, Sunday, or a holiday. So that's October 15th in the deadlines. Then we have required minimum distributions. So this one's a little more broad. So by December 31st of 2025, now we're hitting those year-end deadlines, you must take your required minimum distributions. And you have to take those if you have attained the age of 73 years or older. There is an option, I just talked about this on the full webinar portion, to wait until April 1st of the year following the year that you attain your age 73 currently. But you, not a lot of people want to do that, right? So if you wait until April 1st of the year following the year you attain age 73, then you have to take two distributions in that same year, because you only have the opportunity to delay until April 1st of the year after you attain age 73 for that RMD one time, right? So I can't wait again until April 1st of the following year, the next year when I'm 74 years old. It doesn't continue that way. I hope that makes sense. So traditional IRAs, you have a required beginning date, and once you turn 73 years old currently, you have to take your required minimum distributions. And if you don't, you're subject to a 25% penalty on what you should have taken. That penalty can be reduced to 10% if it's corrected timely. But don't mess around with the penalties, because you've got to you just don't want to have to deal with it. Now many times this penalty is waived, but it's not a given, and there's a lot of work to do to get that penalty not applied. So that's IRAs. So traditional IRAs and traditional. Now, when you see the word traditional, that really means think non-Roth IRAs. And there's a reason I'm saying that. But traditional IRAs, traditional 401ks also. So you can't aggregate IRAs and 401ks. So make sure that you're not falling down that trap. So if you have $1 million, let's just say, between your IRAs and your 401ks, you can't just pull them all together and say, I'm going to take my RMD out of the total $1 million that I have completely, the total amount between my IRAs and 401ks, and take that distribution. You have to calculate them separately. Separate IRAs and 401ks. But there's some certain rules with 401ks. There's this still working exception. So if you're still working, you're past age 73 and you're still working, then you may be able to avoid taking that RMD. And you must still be employed by the current employer in that retirement plan. So if you work for ABC Company, you have to still be in the ABC plan. And in that ABC plan, then you may be able to delay taking those required minimum distributions. Any previous 401ks or IRAs, you still have to take your RMDs. It only applies to the plan where you're working. So you must still be employed by your current employer with a retirement plan, and you must be less than a 5% owner of the company. So if you're greater than a 5% owner of the company, you have to take your required minimum distributions. And then we have some inherited IRA owners must also take required minimum distributions by December 31st, 2025. So some eligible designated beneficiaries don't have to take distributions, but if you're non-eligible designated beneficiary, it's likely you have to take required minimum distributions. And because once the RMDs begin for the account owner, they must continue. So what do I mean by eligible designated beneficiary or non-eligible designated beneficiary? Here are eligible designated beneficiaries. Number one is a surviving spouse. The account owner's spouse who inherits the account. Pretty clear. That is an eligible designated beneficiary, and if set up correctly, that person would not have to take required minimum distributions. A minor child, a child who is under the age of 21, as defined by the IRS for this purpose, regardless of their state law age of majority. Disabled individual. Oh, I missed that. That's two. Then we have a disabled individual, an individual who meets the IRS definition of disability. The chronically ill individual, an individual who meets the IRS definition of being chronically ill and not more than 10 years younger than the account owner, the IRA account owner, and an individual who is not more than 10 years younger than the original account owner. All those folks are eligible designated beneficiaries and have some options to potentially avoid RMDs. But if you don't fit into those categories, non-eligible designated beneficiaries, you may have to take RMDs from these inherited IRAs. Another December 31st deadline is qualified charitable distributions. So qualified charitable distributions, that's when you take funds from your traditional IRA and you send them directly to a charity. You cannot be in receipt of those funds at all. You send them directly to a charity, and there is no tax event there as long as it's a qualified charity under the IRS regulations. You must be at least 70 and a half years old. It's not the year that you turn 70 and a half. You must have crossed your 70 and a half birthday. So start celebrating those half birthdays. But any qualified charitable distribution must be done by December 31st, 2025. And a big one for us, of course, is Roth conversions. So Roth conversions must be done by December 31st, 2025. And you see this asterisk here. I put the asterisk there because please don't wait. Please don't wait until December 31st, 2025. Custodians have deadlines that they give us where we have to have this work done. And it's never December 31st. They'll say, well, sure, we can process it by December 31st, 2025, but it's usually on the best efforts principle. So we want to make sure those conversions are done for sure. RMDs, if you're subject to RMDs must be done first. You can't convert RMDs. So if you're doing Roth conversions and you're over 73 years old currently, you have to take those RMDs before you do conversions. I say that because when people wait until the last minute, it's difficult to get those things done at the same time. The funds must leave your custodian no later than December 31st, 2025. So technically, you don't have to have the money contribute or redeposited into your Roth IRA, but the funds for the Roth conversion have to leave the traditional IRA custodian by December 31st, 2025. They must leave that IRA account. Best to have it all wrapped up and done by the end of the year, though. Now, considerations. So now you know some of the deadlines. Considerations for year-end planning. Well, we want to look, so we send our clients a year-end planning form. So if you're a client and you're listening, you've received that form. If you've returned it already, we really appreciate that. If you haven't already returned it, please take a minute and fill it out. It helps us get you all teed up and ready to go for the end of the year and do everything that we need to do. If you're not a client yet and you want to talk to us about that, you can reach out to us at questions@attleborowealth.com. That's questions@attleborowealth.com. You can also go to our website and request an appointment with me. If you have more than $1 million of invested assets, you can request an appointment with me. If you generally just have questions, again, you can send information into questions@attleborowealth.com. But we want to pay attention to a lot of things when we're gathering this information for year-end planning. And so here are some considerations. Well, we need to know about all income. So you should be paying attention to all income. So what does all income mean? So surprisingly, this comes up. Well, of course, wage income. So if you're still working, let's get an idea of how much you've earned so far this year and what you're projected to earn for the rest of the year and if there's any changes happening. And that includes bonuses. That includes pensions. So if you're still working, let's stay with these two for a second. You might have a year-end bonus. So hopefully by now you know what that's going to look like potentially for the end of the year. Let's get an idea. And if you're working on this yourself, do a calculation of what that might be, because there are things you might want to take advantage of by the end of the year, like Roth conversions, but you need to understand what kind of income you're working with so that you can decide what tax rate you're going to pay on those Roth conversions. And that includes, of course, pensions. So if you receive pensions, figure out how much of that is going to increase your taxable income, right? If you received it for a short period of time, or maybe for the whole year this year, maybe you just retired in June and you just started receiving those pensions, figure out what that calculation is and how much that's going to be for the rest of the year. Rent is included. So you might have your, you might have some benefits to your rent structure. I know a lot of people, you've got costs associated with your rents. And so your net amount, you might net out zero with your rentals, or it may be a smaller amount. But this is information you've got to review, because again, depending on how you're structured, if that rent passes through to you, then that's going to be income to you. So any rents. Distributions from retirement accounts. This is one we get all the time. We'll have people say, all right, this is how much I earned. This is how much I did in pensions, or received in pensions or other income. And they'll forget to tell us about distributions from retirement accounts that maybe they don't have under our management. And they'll say, oh yeah, by the way, I distributed $50,000 to pay for X, Y, or Z. Well, that's important to know. So please include that information. And when you're doing your own evaluation, make sure you're pulling everything in. That includes, of course, annuity income and other plan distributions. So you may have things you want to get done by the end of the year, and you may have distributions from your IRA accounts or your other investment accounts. And along with that, if you have things that you want to do, you might end up with realized capital gains or losses. Even if this relates to taking money out of non-IRA accounts. So if you have significant growth in your investment accounts and you want or need to take a distribution, you might have some realized capital gains. Now, capital gains are taxed differently than ordinary income, but it still calculates into your total tax amount for the year. So you can do some good tax planning if you understand the differences, and if you pay attention to what those projected gains are going to be. Now, that can change. The markets can change, so they could turn into losses by the end of the year. But we also want to pay attention to losses, because losses can offset gains, and we can carry forward losses. You might already have some loss carry forwards that might help your tax situation. So realize capital gains and losses. And as I said, there's plan capital gains and losses. And don't wait until the last minute. So if you're a client of ours, please don't wait until the last minute. Let's make sure we get those documents in as soon as possible. If you're considering becoming a client of ours, please don't wait until the last minute. We only accept a few clients a month, and we have a lot of preparation to do. And as the end of the year gets closer, so again, this is broadcasting on September 24th, 2025. You may be listening to it, I don't know when, but But as the end of the year gets closer, it gets more difficult every day for us to take care of the new folks who come in and want to get work done like Roth conversions. So almost every year we have somebody contact us in late November, early December and say, you know what? I saw you on YouTube. I attended one of your classes, or we met before 3 or 5 years ago or 6 months ago. And now we want to move forward and we want to get this done by the end of the year. And that's really, really hard, folks. So please don't wait till the last minute. We do have some room right now for the rest of the year. So if it's, you want to have a conversation about onboarding and if we're a good fit, let's have that conversation and see if we can work with you. And yeah, but please don't wait till that last minute. All right. So let me wrap up here. We went over some deadlines. We went over other considerations. And let's jump back. So I'm just going to give you some announcements. So I changed the format a little bit. We're going to have our announcements at the end of the webinar. But I hope that was helpful. We have some upcoming events. So tomorrow night we are hosting a screening of The Psychology of Retirement at the Newtown Theater, a great movie by Morgan Housel and crew. And we still have some seats available. I think we have about 185, 190 people who have responded or registered. I don't expect all those folks to show up. I hope they do, and I hope people come out. But this is an education series that we're continuing. It's a great movie. If you haven't seen it already, or if you want to see it again, come on out. We'll give you some popcorn. You'll be able to watch a great movie, and I even have some books I'm going to give away because I'm listening to a great book. I may have shared it with you. The algebra. The Algebra of Wealth, I think it's called. Scott Galloway is the author, and I just can't recommend it enough for younger people. It's very, very good. But again, tomorrow night, September 25th at 6:15, starting at 6:15, is The Psychology of Retirement at the Newtown Theater. We've got a tentative class in November, and I'll give you the final dates next week when I see you. So that's going to be in November at the Mercer County Community College. This is another encore event. So we had over 65 some people on a wait list for our last class. We tried to host some of those people on Zoom live during the class, and then we decided to see if we could schedule another live class. So we've got that for the middle of November it is. So keep an eye out for that if you'd like to attend that live. Jerry has a question. What are my thoughts on buffered ETFs? I have a lot of thoughts on buffered ETFs, Jerry. So we use buffered ETFs in our portfolios. I think they can be a good addition to the portfolios in the right place for the right person. But I'm happy to talk about that more offline if you'd like to have a question about specifically for you. So we've been using buffered ETFs probably 18 months or more now. And a buffered ETFs, folks, for those of you who don't know, it's an exchange traded fund that offers some downside protection based on different conditions in the market, and they can vary widely. But we've talked about those specifically on different webinars. And if you're clients and you want to hear more about how we use buffered ETFs, you can watch the video with Lydia, our Chief Investment Officer, that we had a few weeks ago. And that's available to you only clients. That's a private link that you have in an email that was sent out to you a couple weeks ago. All right. Seeing no other questions, I hope this information was helpful today. I apologize for the clunking around a little bit because my little gadget wasn't changing scenes, but we'll work on that hopefully for next week. And everything else worked well. Sound and video looks good. And I hope you all have a great week. Take care.